China just pulled the trigger, not with missiles, not with warships, with $850 billion worth of US Treasury bonds. And while you were sleeping last night, they moved another $12 billion out of American debt. This isn't a warning shot anymore. It's a full-scale financial attack designed to collapse your mortgage rate, destroy your bank's balance sheet, and end the dollar's 80-year reign as the world's reserve currency. In the next 25 minutes, I'm going to show you the exact timeline of this sell-off and the 3 assets you need to own before the cascade begins. Before we begin, subscribe and hit the notification bell. Comment gold if you're moving out of dollars or dollar if you're staying put. This information could mean the difference between preserving your wealth and watching it evaporate. $850 billion is not just a number on a balance sheet. It is a loaded weapon pointed directly at the heart of the American housing market. And as of this morning, the finger on the trigger belongs to the People's Bank of China. For the first time in history, the threat of a treasury dump has moved from conspiracy theory to mathematical certainty. We are watching a geopolitical divorce that will fundamentally reprice every single asset in your portfolio. The 30-year fixed mortgage rate is about to detach from reality and skyrocket, regardless of what the Federal Reserve does. If you thought 7% mortgage rates were painful, you're not ready for what happens when the largest foreign creditor walks away. The real number they're not telling you to understand the magnitude of this threat. We have to look at the agency debt loophole that most analysts ignore. The headline number for Chinese holdings of US Treasuries is sitting at roughly $760 billion. But when you add in the debt of US agencies like Fannie Mae and Freddie Mac, the total exposure is closer to $850 billion. This is the nuclear option leverage that Beijing holds over the United States economy today. For 2 decades, this relationship was symbiotic. China sold us cheap goods, and we paid them in IOUs called treasury bonds. They recycled those dollars back into our debt market, keeping our interest rates artificially low and their currency competitive. It was the greatest financial trade in history for the American consumer, effectively subsidizing our standard of living. The trade war that broke everything but the trade war of 2026 has officially broken that cycle and turned a partner into an adversary. When the US implemented 60% tariffs on Chinese exports, we essentially told them their dollars were no longer welcome. So logically, they have stopped recycling those dollars into US debt and started liquidating their existing positions. The latest Tiki data confirms that China has been selling US assets at the fastest pace since 2015. This is not a random fluctuation. It is a strategic state-level decision to de-dollarize their entire economy. They are selling US treasuries and using the proceeds to buy physical gold bars by the ton. The People's Bank of China has added to its gold reserves for 28 consecutive months, a record streak. They are trading paper promises from a hostile government for Tier 1 collateral that has no counterparty risk. They watched what happened to Russia's reserves in 22, and they are ensuring it cannot happen to them. The missing buyer problem. But the problem for you is not that they are buying gold. The problem is who is not buying the bonds they are selling. The US government is currently running a $2 trillion annual deficit, requiring constant new debt issuance. We need to sell billions of dollars of bonds every single week just to keep the lights on in Washington. In the past, China would show up to the auction and buy a massive chunk of that debt without hesitation. Now they are not only absent from the auction, they are actively selling their old bonds into the secondary market. This creates a massive supply glut where there are simply more bonds for sale than there are buyers. When supply exceeds demand, the price of the bond collapses mathematically. And in the bond market, when the price goes down, the yield or interest rate goes up immediately. This is why the 10-year Treasury yield is spiking, despite the fact that inflation is technically cooling down. The market is realizing that there is no marginal buyer left to absorb the tsunami of US debt. The Federal Reserve is currently doing quantitative tightening, meaning they are selling bonds, not buying them. US banks are already holding too much government debt and are sitting on massive unrealized losses. Japan is struggling to defend its own currency and has turned into a net seller of US treasuries as well. This leaves the American domestic investor as the only one left to fund the government spending spree. But to convince an American investor to buy a 10-year bond, the government has to offer a much higher interest rate, the mortgage rate decoupling. This crowding out effect forces yields higher across the entire curve, impacting every loan in the economy. And the most direct impact is on the 30-year fixed mortgage, which tracks the 10-year Treasury yield. If China's selling pushes the 10-year yield to 6%, mortgage rates will mathematically hit 9%. We are seeing a complete decoupling of mortgage rates from the Fed funds rate. Because of this dynamic, the Fed could cut rates tomorrow, but if China dumps $50 billion in bonds, mortgage rates would still go up. This effectively neutralizes the Federal Reserve's ability to stimulate the housing market or save the economy. We are entering a period of fiscal dominance where debt supply matters more than monetary policy, financial warfare without firing a shot, and the Chinese government knows exactly how much pain this causes the American middle class. They know that housing is the primary engine of the US economy and the primary source of household wealth. By keeping interest rates high, they can engineer a recession in the US without firing a single shot. It is a form of asymmetric financial warfare that leverages our debt addiction against us. The timing of this accelerated selling aligns perfectly with the escalation of semiconductor sanctions. It is a tit-for-tat retaliation. You cut off our chips, we cut off your chip credit. The difference is that China can survive without high-end Nvidia chips for a few years. The US economy cannot survive with 9% mortgage rates for a few years without a massive collapse. The commercial real estate domino. The commercial real estate market is already teetering on the edge of insolvency due to refinancing risks. A further spike in rates caused by foreign selling would be the final nail in the coffin for office towers. We are looking at trillions of dollars in real estate value being wiped out by a shift in bond yields, and the US Treasury is powerless to stop it unless they force the Fed to restart the money printer. But if the Fed starts printing money to buy the bonds that China is selling, inflation will explode again. We would be monetizing the debt of a foreign adversary, destroying the value of the dollar in the process. The trap Beijing has set. This is the trap that Beijing has set. Either suffer a deflationary depression. There is no soft landing when your biggest creditor decides to pull the plug on the relationship. The data shows that China is using custodians in Belgium and Luxembourg to mask the scale of their selling. So the official number of $760 billion is likely an understatement of the selling pressure. They are using every rally in the bond market as an opportunity to unload billions more in exposure. This puts a hard ceiling on bond prices, meaning interest rates have a floor that they cannot break through. The days of 3%, 4%, or even 5% mortgages are likely gone for a generation. We are reverting to the historic norm of high capital costs driven by the lack of foreign subsidies, paying the geopolitical premium. The exorbitant privilege of the US dollar is being eroded trade by trade, bond by bond. If the world no longer wants to hold our debt, we have to pay a massive premium to fund our lifestyle. That premium is paid by you in the form of higher credit card APRs, higher auto loans, and higher mortgages. You are paying the geopolitical risk premium every single month, whether you realize it or not. The standard of living in America was built on the back of cheap foreign capital that is now gone. We are witnessing the unwinding of 40 years of globalization in the span of 40 months. The plumbing of the financial system is complex, opaque, and boring until the moment it explodes and takes your retirement with it. Right now, a critical valve in that plumbing, known as the reverse repo facility, has run completely dry after draining for months. The $2 trillion cushion that disappeared for the last 2 years, this facility acted as a massive liquidity reservoir, holding over $2 trillion of excess cash. It was the shock absorber that allowed the US Treasury to issue trillions in new debt without instantly breaking the markets. When the government needed to sell bonds, money flowed out of this facility to buy them, keeping interest rates relatively stable. But as of this month, that $2 trillion cushion has been depleted down to effectively zero. This means the easy money that was soaking up the government's debt issuance is gone forever. Now every dollar the government borrows must come directly from the existing liquidity in the banking system. This is happening at the exact same moment that China is dumping its $850 billion position. It is a supply shock meeting a liquidity cliff, creating the perfect storm for a volatility explosion. The banking system under siege without the reverse repo buffer. The banking system's reserves are becoming scarce, driving up the cost of overnight funding. This puts immense pressure on regional banks that are already struggling to survive the high interest rate environment. We are watching the unrealized losses on bank balance sheets metastasize into a solvency crisis. When bond yields rise driven by Chinese selling, the market value of the bonds held by US banks crashes. According to the FDIC, US banks are currently sitting on over $600 billion of unrealized losses on securities. These are bonds they bought when rates were low, which are now worth 30 or 40% less. As long as they don't have to sell them, they can pretend the losses don't exist and hold them to maturity. But if depositors get scared and start withdrawing money, the banks are forced to sell these bonds at a loss. This is exactly what happened to Silicon Valley Bank in 2023. But now it is happening to the entire system. China's deliberate strategy. China's selling pressure is forcing yields higher, which makes those unrealized losses grow larger every single day. It is a deliberate strategy to weaken the American banking sector by attacking its capital base. Beijing knows that the US banking system is the Achilles heel of American superpower projection. If the banks are broke, they cannot lend. If they cannot lend, the economy grinds to a halt. And the Federal Reserve has lost its primary tool for bailing them out without causing inflation. The Bank Term Funding Program that saved the banks in 2023 has expired and cannot be easily restarted. This leaves the Fed with a binary choice: let the banks fail or print trillions of dollars to monetize the losses. Both options lead to the destruction of the dollar's purchasing power for the average American consumer, the petrodollar under attack. This financial fragility is being exacerbated by the de-dollarization of global energy trade. For 50 years, the petrodollar system ensured that oil was traded exclusively in US dollars. This created a permanent structural demand for dollars from every country that needed to import energy. But China, the world's largest oil importer, is now paying for oil in yuan using swap lines with Saudi Arabia. This petro-yuan arrangement bypasses the US financial system entirely, reducing global demand for dollars. Saudi Arabia is openly accepting currencies other than the dollar for its oil exports for the first time in decades. This is a direct attack on the exorbitant privilege that allows the US to run massive deficits without consequence. If the world needs fewer dollars to buy oil, they have less reason to hold US Treasury bonds as reserves. The pincer movement. This structural shift aligns perfectly with the tactical selling of bonds we are seeing from the PBOC. They are attacking the dollar from both the supply side, dumping bonds, and the demand side, buying oil in yuan. It is a coordinated pincer movement designed to end the era of US financial hegemony, and the impact is already showing up in the term premium of US debt. Investors are demanding significantly higher compensation for the risk of holding long-term US bonds. They realize that the US government has no credible plan to reduce the deficit or stabilize the debt. The only plan is to issue more debt to pay the interest on the old debt, a classic Ponzi scheme dynamic. When the biggest foreign investor, China, calls the bluff, the Ponzi scheme begins to unravel rapidly. We are seeing failed auctions where the Treasury struggles to find buyers for its new debt issuance. Primary dealers are being forced to step in and buy the unwanted bonds, clogging up their own balance sheets. This limits their ability to make markets and provide liquidity to the broader financial system. It creates a liquidity trap where it becomes difficult to buy or sell large positions without moving the price. In this environment, a sudden geopolitical shock could cause the entire bond market to seize up instantly. If the Treasury market freezes, the global financial system freezes, as Treasuries are the collateral for everything. The Fed's impossible position. The Federal Reserve is acutely aware of this risk, which is why they are talking about slowing the runoff of their balance sheet. They are terrified that the bond market is on the verge of breaking due to the lack of buyers. But slowing the runoff is just a band-aid on a gunshot wound. It does not solve the fundamental problem. The fundamental problem is that the US government spends too much money and relies on enemies to lend it to them. Now that the enemies have stopped lending, the spending must be financed by inflation. This means the price of everything you buy, food, gas, insurance, must go up to pay for the government's debt. It is a stealth tax levied on every holder of US dollars to bail out the Treasury and the banks. The choice between disasters. The Chinese government is effectively forcing the US to choose between hyperinflation and a depression. They are betting that American politicians will always choose inflation to avoid short-term pain. And history tells us that is a very safe bet to make. So we should expect the Federal Reserve to eventually pivot and start printing money again aggressively. They will call it yield curve control or market functioning support, but it is just money printing. This will temporarily save the bond market and the banks, but it will destroy the currency. We are looking at a future where the dollar loses value at an accelerating rate against real assets. The crack-up boom. This is why we are seeing a crack-up boom in the price of things that cannot be printed. The stock market is rising in nominal terms, not because companies are more profitable, but because the dollar is worth less. It is the Venezuela dynamic applied to the world's largest equity market. Investors are fleeing cash and moving into anything that will hold its value against the coming devaluation. But the safe asset of the last 40 years, the US Treasury bond, is now the source of the danger. The 60/40 portfolio is structurally broken because bonds and stocks are falling together. The global exodus from dollars China has exposed the fragility of the entire Western financial construct by simply stepping away. They have shown the world that the risk-free rate is actually full of risk. Other nations are taking note and accelerating their own diversification out of the dollar. The BRICS nations are actively building an alternative payment system to bypass SWIFT entirely. They are hoarding gold at a rate that suggests they are preparing for a new monetary standard, a standard where trade is settled in hard assets and commodities, not in unbacked fiat currency. The US is finding itself increasingly isolated in a world it used to dominate completely, and the American consumer is the one who will pay the price for this loss of status. The wealth effect reversal. The standard of living in the US is artificially inflated by the dollar's reserve status. As that status erodes, imports become more expensive and purchasing power evaporates. We are already seeing this with the price of imported electronics, clothing, and machinery. The China price that kept inflation low for 20 years is gone, replaced by the war price. Supply chains are being rerouted to more expensive countries like Vietnam and Mexico. This friendshoring is inflationary by design, as it prioritizes security over efficiency. The era of just-in-time efficiency is over. The era of just-in-case redundancy is here, and redundancy costs money, massive amounts of money that the consumer does not have. The US economy is 70% consumption. If the consumer is tapped out, the economy collapses. The wealth effect from rising home prices and stock portfolios is the only thing keeping spending alive. But if China's selling crashes the bond market, the housing market follows, and the wealth effect vanishes. A vicious cycle. This is the negative feedback loop that keeps central bankers awake at night. A crash in bonds leads to a crash in real estate, which leads to a crash in consumption. That leads to a recession, which leads to lower tax revenues and higher deficits. Higher deficits require more bond issuance, which leads to lower bond prices, restarting the cycle. China knows this loop exists, and they are feeding it with every bond they sell. They are accelerating the entropy of the US fiscal position with cold, calculated precision. It is the financial equivalent of a siege, cutting off the supply of cheap capital to the fortress. The inhabitants of the fortress, you and me, are starting to feel the hunger pains of inflation. The fiscal straitjacket, the interest expense line item, on the federal budget is growing exponentially. It will soon consume the entire discretionary budget of the United States government. This means no money for roads, bridges, schools, or scientific research. All the tax revenue will go to paying for entitlements and interest on the debt. This is the fiscal straitjacket that China has helped tighten around Uncle Sam. There is no wiggle room left, no fiscal space to stimulate the economy in a downturn. If a recession hits now, the government cannot afford a stimulus package without destroying the currency. We are flying without a parachute. The ground is rushing up to meet us. The Great Wealth Transfer Mechanism. The Great Wealth Transfer is not a conspiracy theory. It is a mechanical function of a sovereign debt crisis. When a government cannot pay its bills through taxation, it pays them through inflation, which is a tax on your savings. The United States government has entered a phase where it must devalue the currency to keep the system solvent. This devaluation is the mechanism by which the purchasing power of your bank account is transferred to the state. You work for dollars, you save in dollars, but the government prints dollars for free, diluting your labor. China understands this dynamic perfectly, which is why they are exiting the dollar system entirely. They are refusing to hold a currency that is destined to be debased by the trillions in the coming years. The central bank gold rush, and they are not alone. The smartest money in the world is quietly moving towards the exit door. We are witnessing a bank run on the United States dollar by the world's central banks. According to the World Gold Council, central bank gold buying has reached its highest level in over 50 years. They are not buying gold because they like shiny rocks. They are buying it because it is the only neutral asset. In a world of weaponized finance, gold is the only reserve asset that cannot be frozen by a sanction. It is the only asset that does not have a counterparty who can default on the promise to pay. The People's Bank of China has been leading this charge, aggressively converting their trade surplus into bullion. They are explicitly preparing for a post-dollar world where trade is settled in tangible value, not fiat promises. This is a return to Gresham's law of economics. Bad money drives out good money. The bad money is the US dollar, which is being printed to infinity to fund deficits. The good money is gold, which is being hoarded by the nations that produce real goods. You must pay attention to what central bankers do, not what they say in their press conferences. They tell you that gold is a barbarous relic and that you should trust the stability of fiat currency. Yet they are stacking bars of this relic in their vaults at a frantic pace, ignoring their own advice. This is the ultimate insider trade, and they are front-running the inevitable collapse of the bond market. Action step 1. Understand your portfolio risk. The 60-40 portfolio, 60% stocks, 40% bonds, is mathematically dead. For 40 years, bonds were the safe part of your portfolio that protected you when stocks went down. But in an inflationary debt crisis, stocks and bonds fall together, leaving you with nowhere to hide. This positive correlation between assets destroys the diversification that retirement funds rely on. Holding US Treasury bonds today is not risk-free return. It is return-free risk. You're accepting a 5% yield on an asset that is losing 7% of its purchasing power. That is a guaranteed loss of wealth, mathematically programmed into the investment vehicle itself. Action step 2. Move into hard assets. So where does capital go when it flees the bond market and the dollar? It flows into hard assets, things that cannot be printed by a central bank or debased by a politician. This includes productive farmland, energy infrastructure, industrial commodities, precious metals. These are the assets that survive a currency collapse because they have intrinsic utility in the real world. China is securing these assets globally, buying mines in Africa and farmland in South America. They are trading their depreciating dollars for copper, lithium, oil, and arable land. They are converting paper wealth into real wealth before the music stops playing. Action step 3. Audit your net worth. You should be looking at your own net worth and asking how much of it is paper versus real. If your entire wealth is in a bank account and a 401k invested in financialized assets, you are vulnerable. You are the counterparty to the government's debt, and you are the one who will take the haircut. The everything bubble was built on cheap credit. The everything bust will be driven by the repricing of that credit. As interest rates settle at a permanently higher plateau, valuations for stocks and real estate must compress. Action step 4. Become your own central bank. You need to become your own central bank, holding reserves that are outside of the banking system. This means having physical possession of assets, not just a paper claim on an asset held by a custodian. If you own paper gold in an ETF, you do not own gold. You own a claim on a bank. In a systemic crisis, that bank may declare force majeure and settle your claim in worthless cash. The distinction between ownership and claims will become the most important lesson of this decade. China is taking physical delivery of everything they buy, leaving nothing in the vaults of London or New York. They are draining the physical liquidity of the COMEX and the LBMA, creating a squeeze on the exchanges. Action step 5. Prioritize liquidity. Liquidity in a crisis does not mean having cash. It means having assets that are universally liquid. Gold is the only asset that is liquid in every country, in every currency, and in every crisis. It is the universal language of value that requires no translation and no electricity to transact. This is why the Chinese central bank is buying it. It is their insurance policy against the dollar system. They are building a gold great wall to protect their economy from the coming currency wars. You need to build your own wall around your family's financial future. Action step 6. Act before capital controls. Do not wait for the Federal Reserve to give you the signal to protect yourself. By the time they admit there is a crisis, the capital controls will already be in place. They will try to lock you into the system with digital currencies and bans on cash withdrawals. The central bank digital currency, or CBDC, is the ultimate tool for trapping capital in a failing system. It allows them to impose negative interest rates and prevent you from moving your money into hard assets. This is the endgame of the financial repression that is necessary to liquidate the debt. They need you to stay in the dollar so they can inflate away the value of your savings. If you exit the dollar, you defeat their strategy, which is why they will try to make it difficult. The window is still open, but the door is still open today for those who have the eyes to see the reality. You can still convert your fiat currency into tangible assets without restriction or penalty. This window of opportunity will not stay open forever as the crisis accelerates. The $850 billion sell order from China is just the first domino in a very long chain. It will topple the bond market, then the stock market, and finally the currency itself. We are watching the end of the post-war monetary order and the birth of something new. The transition will be chaotic, volatile, and destructive for those who are unprepared. But for those who are positioned correctly, it will be the greatest opportunity of a lifetime. Wealth transfers is never destroyed. Wealth is never destroyed. It is merely transferred from one set of hands to another. It is transferring from the hands of the oblivious creditor to the hands of the prepared owner. You have a choice to make. Will you be the creditor who gets paid in worthless paper? Or will you be the owner who holds the assets that the world actually needs? The Chinese government has made its choice, and they are moving with speed and conviction. They are betting against the dollar, and they are betting on the laws of mathematics. I suggest you look at the math yourself and decide if you want to be on the other side of that bet. The time for complacency is over. The time for action is right now. Protect your purchasing power. Reduce your counterparty risk. Get out of the debt system. The storm we have been warning you about is no longer on the horizon. It is overhead. The rain has started to fall, and the shelter of the old financial world is leaking. Build your ark, load it with hard assets, and prepare for the flood of liquidity. If this investigation opened your eyes to the reality of the global economy, share it immediately. Send it to your friends, your family, and anyone who relies on the dollar for their survival. Subscribe to the channel and turn on the notification bell so you are alerted to the next crisis signal. We will continue to track the bond market, the gold flows, and the geopolitical moves daily. Together we can navigate this collapse and emerge with our wealth and our freedom intact.